innovation is really, really difficult in this. And I think you can easily come away with the perspective that innovation is not wanted.
What works today doesn't, may not necessarily work tomorrow. And so being adaptive and dynamic with the market, is kind of a survival trait.
Overall, consumer price inflation rose to 2.4%, but it's almost entirely due to increasing shelter costs.
There had been 4 months of consecutive declines in consumer confidence, but it kind of had a sharp rebound.
Episode 45 of Market Moves with Mark and Jeff. Jeff, good to be with you today. Excited to be talking about real estate and the economy a bit more. We will start off with kind of a bombastic headline from the guy that maybe is most notable banker these days, Jamie Dimon. And I was just really curious to get your thoughts on this, Jeff, because I don't know if you look at the thumbnails on the first 45 episodes of this podcast, you might say that the Market Moves podcast agrees with Jamie Dimon here on some level. But to quote Jamie Dimon, if you add it all together, it's probably lost money in the last 50 years combined. This is Jamie Dimon talking of the bank's mortgage business. He had these comments at Morgan Stanley's investor conference, but he goes on to say, and excuse the R language here, but it is a shitty business, and it's being made worse by regulators and rules and regulations. But I think we can eke out a decent return there over time, and we're working on that. Jeff, let's start there. What do you think?
Well, being in the mortgage, or at least, servicing a section of the mortgage space on the appraisal side, his comment of eking out a decent return, this seemed to resonate a little bit. It's like in the best of circumstances, you might actually be able to make a little bit of a profit, and not that that's a real calling card for people looking to get into a business or a space or something. It's interesting to see how candid he was in the perspective on this part of the business, because for them, they've got a whole bunch of lines of business and revenue that comes in. Originating mortgage loans is, not nearly as significant as it was. And I've seen some reporting on trends, between the Chases, the Wells, even Bank of America's, and the big national banks have not originated as much of a percentage of the total loans on residential mortgages as others have in the last decade or so. They used to have a bigger share of that market. I had heard somebody speculating they were looking to get back into it, but Jamie's comments seem to suggest that he'd be happy to not lose money on the thing. I don't know how much market share he's trying to gain in the moment.
Jim, I think he is speaking about the mortgage business generally, but I certainly think it extends well to the appraisal business. It's been really, really difficult. And, we've talked about, at least loosely on this pod, that the excitement and the activity in the mortgage and appraisal businesses during COVID brought in a lot of investment dollars into the appraisal space for sure, and into the mortgage space as well. Yeah. But I find some of that has retreated to some degree because it's just a shitty business on a lot of levels. You've got rules and regulations. I think we're some of the most regulated industry in the country, and innovation is really, really difficult in this. And I think you can easily come away with the perspective that innovation is not wanted. That there is whether it's a lack of risk tolerance towards change. We've talked a lot about this as it relates to AI and other things out there. So on some level, it might protect us from some of the changes coming our way, or at least slow some of the changes that are coming with artificial intelligence and automations and that sort of thing. Part of that is because it's just a really, really difficult and nuanced business to put together.
It really is, Mark, and his comments, they resonated. When he talks about it being terrible because of regulators and regulation and rules, like all of this stuff you just have to navigate and deal with. I think you're right. And I think, especially even on the appraisal side, to become an appraiser takes a lot more time, a lot more investment, just a lot more hoops to jump through than, to participate on the mortgage side or the real estate brokerage side or that sort of thing. And so, just that there's a lot of rule and regulation and things to deal with. On the one hand, makes sense. I hadn't actually, thought about maybe connecting these dots in this way, but as we're talking about it, I'm going to share a quick history of the stock price of Fannie Mae and see if I can connect these intellectual dots or not. I may not be able to, but you can pick on me for not. But I think part of the reason that there's such a focus on the rules, on the regulations, is when you look at what Fannie Mae has done over time. I don't know the exact year they started, but 1980 or thereabouts. They had a pretty healthy run up in stock by mitigating risk, buying mortgages on the secondary market, to ensure liquidity within the market for buying and selling homes. But when they, the stock price ran up, the company was doing great. Freddie Mac followed the very same trajectory here. But when they fell off a cliff during the great financial crisis in around 2008, they and Freddie were taken into conservatorship. And I think that's where a lot of the regulation, really proliferated. Even on the appraisal side, I mean, the appraisal requirements to become an appraiser ratcheted up significantly. Had to have a college degree, had to take more hours in classroom training, had to get more experience and all those sorts of things. And I think part of the reason for the regulation is a concern about repeating, having history repeat itself. And so what we tend to do naturally is say, well, we're never going to let that happen again. So we're going to regulate that possibility out of existence. And I don't know if we really can or not, but it struck me as we're talking about, Jamie's perspective on how hard it is to navigate in this space. And a lot of it is a result of the 2008 great financial crisis. You wind the clock back, another 20 years coming out of the saving and loan crisis. And that's when licensing for appraisers was, proliferated in the first place, was because of another, large scale financial cycle that worked its way through. And, so I mean, geez, working in the highly regulated space is incredibly difficult. I can see where it comes from. I don't know if it ultimately prevents another, crash and cycle or not, Mark, but this chart kind of shows the history of the proliferation of the regulation as a response to what's happened in the market.
Jeff, I feel like we could probably spend, and maybe we will, spend this whole podcast talking about this topic. I have so many thoughts around it. And, that regulation increase, which you and I have maybe not said outright, but certainly behind the scenes feel that the regulation and overburden there was at a pinnacle during this latest Biden administration, with the PAVE task force and then all sorts of other things there. It's just a very tricky time to be doing what we do. And yeah, I mean, it was 2010 when I had instructors teaching appraisal classes to me saying, it is, you are taking on more risk than the $400 fee that you're getting for each one of these things. That was certainly a over dramatized statement, but there's like a kernel of truth in that there is a lot of liability in what we're doing here. And we've talked about the spread between the 10-year and the 10-year Treasury and the mortgage rates being at least decade highs, but among the highest that we've seen in many, many decades. And a lot of that is that you just have to charge a higher interest rate than what the bank or lender themselves can borrow at because of the regulatory burden on top of it. So there's a lot there. And I've thought about, Jeff, introducing as a topic here. My father, Ken Verrett, passed away in 2018, but had used to write articles on Brian Davis's Appraisal Scoop blog for any of the appraisal history buffs out there. But was talking one about the proliferation of appraisal management companies, kind of how they came to be, but also the commoditization of the mortgage. It used to be in the 80s and wherever that the loan was made on Main Street in the town that the property sat in. And over the course of a decade and a half, that moved to some central place in New York or wherever. And so it just became commoditized, and that led to a whole host of changes that we dealt with here. And it certainly led to the prominence of the appraisal management company, as I see it. And that article, or the series of articles that he was writing there, made it into Working RE, I think are pretty applicable today. And what you see is the top 5 or 10 lenders, if you take snapshots from 10 years ago, 5 years ago, and today, are totally different. It is taking, I think of the nation's largest lender today, who, from my standpoint, was hardly around 5 or 10 years ago, United Wholesale Mortgage. And in this nuanced area, they're only taking on 30 or 40% of the market in the broker originated deals. But it takes nuance in a unique way to go about whatever this the current state is. And those that were traditionalists and maybe tried to apply traditional methods aren't winning.
Yeah, exactly right. And it's really interesting that you mentioned that, Mark. I don't know how many mortgage brokers that I've talked with. I mean, not that like I talk with hundreds or thousands of them, but I've got some friends here in the community, and every one of them has been invited back to United Wholesale's campus in Michigan, kind of given the tour. They have some training and some stuff. It's just, as you talk about it being a nuanced approach, I mean, they're very intentional about what they do to court and to train and to support the mortgage brokers that they work with, including like paying to bring them physically on site to, give them exposure. And that's just not anything that, was done when the mortgage was originated by your local bank or community credit union or savings and loan or whatever. And, so the approach, and to your point, I mean, it is like a central location, and they're just one example, of course, of other national players out there that really have a big market share. But as a result, it changes everything, or at least a lot of things, with the way that the loan is originated, the way that they contract to get the services from appraisal to title and everything else that has to go into, making a mortgage. But it's just, interesting having heard the firsthand perspective of what they're doing to court that business that I've not seen or heard of ever being done by, any other wholesale or other large scale lender.
When I listen to the Matt Ishbia, the UWM CEO, on quarterly earnings calls and that sort of thing, I could tell you that I don't think he shares Jamie Dimon's outlook of this being a shitty business. They have rocketed to the top. Maybe a poor choice of words with rocket, but they have bought the Phoenix Suns, Phoenix Mercury. I think they're buying Chicago White Sox, where the family is here now. And, so they've done really, really well. And you've seen Rocket do well with a different outlook, which is more kind of the retail and, a big marketing arm, bringing phone calls into a call center and getting deals done that way, being really heavy into refi, but now not resting on their laurels here, but acquiring Redfin and Mr. Cooper on the servicing side. And so they're just a behemoth and growing more and more. So, I think all of these, the new rules of the playing field that have been around for a little bit and maybe are easing a little bit with this administration. We'll see if that takes place, the reduction of regulation, and then holds in the next one, whenever we have a new election. But they've risen to prominence. They've consolidated. They're taking advantage of consolidation with the new rules on the playing field, and see that there is even further to kind of dig their claws into the mortgage space here and market share in a way that I'm not sure it ain't going to get smaller. I don't think. I do think that we probably will see a run of these folks for a decade plus of just gaining more and more market share, where we only have a few major players out there, possibly.
Yeah, and it's a good point. It'll be interesting to look back in 5 or 10 years from now and see if these guys that are currently on the top of the pack stay there, because your point of looking back at a snapshot over 5, 10, and 15 years ago, the major players in the field, some of them aren't even around anymore, and others are diminished significantly from what they were. It's just interesting. It speaks a lot to the challenge of just doing business generally and having longevity out there in the space, because what works today doesn't, may not necessarily work tomorrow. And so being adaptive and dynamic with the market, is kind of a survival trait, but it's not something that everybody gets, even though they at one point are the behemoth that UWM or Rocket or others are in the moment, that they weren't the leaders in the clubhouse 10 years ago. And I wonder, if they will be in 5 or 10 years from now too.
You bet. I don't think this is exactly the innovator's dilemma necessarily, but it sort of feels like from Jamie's comments that a lot of these big banks are in this business because they've always been in this business, but maybe lack the motivation to kind of be innovative within it, and so trying to take care of their customers that bank with them for all sorts of other reasons and just be there when they need a mortgage also. Seems like the play for many of them, if I'm not mistaken. I'm certainly not on the inside, just kind of looking at who the top lenders are and from a while back and who they are now.
Yeah, absolutely. Yeah, that's exactly right. And the theory behind the innovator's dilemma is that you get a new upstart that's willing to take a lower margin and then kind of work their way upstream until they displace somebody. You've seen that in the automotive space. It's just not profitable. And kind of to Jamie's point, it's like they tend to ignore the lower margin, least profitable aspects of the business, and which for them is the mortgage space. And so, it's not a real surprise when an upstart or somewhat other competition comes in and does something, has a unique value proposition that, kind of catapults them forward. And then all of a sudden you're looking up and saying, how did they take over this space that we've historically had, even though we kind of gave it secondary focus and attention because it just wasn't as profitable as investment banking or the other avenues that something like Chase is pursuing.
You bet. Well, Jeff, moving along here, it's notable to me and extra notable maybe over the last couple of weeks. I remember listening to Howard Lutnick, who was on Trump's transition team, and he was talking about the process he used and ran Trump through to select cabinet members. And they were kind of bold and reached outside the norm to fill a lot of these positions. But one thing is very notable to me is you've got a lot of strong communicators in a lot of places. I see these people on TV all the time and talking about a lot of different things. And Treasury Secretary Bessent, it was notable that he is one of those that's out there communicating aggressively and I think communicating well, whatever the message is, whether you like the message or not. I think there's a lot of communication on it, but we saw a headline this week that he is on a short list for Fed chair replacement for Jerome Powell. Did you see this?
Yeah, I did. And as a side note, as leading into this topic, Mark, I'm kind of surprised that Lutnick didn't reach out to you and I in terms of seeking really good community. Can't even say that right, and then maybe I couldn't be surprised that he didn't reach out to us. But you've commented on that before, and it is a very interesting and I think profound insight that a lot of these people, have to be proficient in whatever, their specific responsibility is, but they've got to be really good communicators in the public, on camera, potentially in hostile, situations, answering reporters' questions that may be critical of the administration or something. But, bringing all that back around, interesting to see, as we read just a little bit, Jerome Powell's term as the Fed chair expires in May of next year of 2026. And from what I've seen of Scott Bessent, in the public spotlight, he is a very effective communicator. I think has a clear message. I've heard some concerns, not in reference to him specifically, but in general concerns that whoever is named the follow-up to Jerome Powell by Trump and his administration, how much separation is there really going to be? There's a concern, I think, about autonomy with the Fed, and if it starts to become kind of susceptible to political pressure and influence, it loses some of its credibility, and I think that has negative long-term effects on rates and I think on the integrity of the institution. Now whether Scott would be beholden to what Trump wants or not, I don't know. I remember in the last in the first Trump administration, he was railing on Jerome Powell, wanting lower rates. He's the one who had nominated him for the position in the first place, and then not happy that he's not doing what he wants, right? But I think there has to be a certain amount of backbone in that role to do what you think is right, regardless of what the president happens to be, publicly demanding at the time.
You bet. Well, Jeff, as I was looking at it, and for those that may not be aware, like I wasn't, so Trump did nominate Fed Chair Powell in 2018. It is the president that nominates him. They serve a 4-year term. I don't believe there are term limits at all. And so I think it was Biden that renewed Chair Powell's term for another 4 years. And then, of course, is up in May of 2026 and could be renewed. It doesn't seem like it's moving that way, but could be renewed. And, on the subject of interest rates, you see a ton of people connected to Trump wanting. I think Trump really needs the interest rates to come down. In fact, I think this was like an assumed part of his three-pronged plan to get the economy going, to cut expenses, and to negotiate these tariffs. And the Fed's not cooperating, and I think that's making it a little bit more difficult for them. But I had seen an excerpt from Dr. Lawrence Yun, the economist from NAR, National Association of Realtors, that was, I think maybe signaling an agreement that it is time. I think everybody at NAR would like rates to drop, just like everybody in the Market Moves podcast would like that to happen. But was noting that gas prices plunged 12% from a year ago. Airfares are cheaper. Price of new and used cars have barely moved from a year ago. Overall, consumer price inflation rose to 2.4%, but it's almost entirely due to increasing shelter costs. And I think shelter costs are like maybe a third of the inflation, like consumer price inflation's rating system. And those are going up by almost 4%. A year, even in this climate where we talk a lot about interest rates kind of holding steady at 7, and we talk about prices beginning to come down on some level in a lot of markets. So I read that to say it's an interesting juxtaposition, I guess, because you have the Fed saying we need inflation to lower rates, and I think Yoon's insinuation here is that by lowering rates, you would lower shelter costs and lower inflation, at least in the beginning here. So I don't know. It's interesting to watch. You and I are watching rates constantly. We are not getting the movement that we'd like, and we are now survive beyond the middle of 2025.
Yeah, I was excited for 2025 to get here when our mantra was survive until 2025. Now it's survive through it, and who knows what 26 brings. But you made a really interesting point, Mark, that if interest rates came down, that would kind of have an effective impact on the inflation reading by lowering the shelter cost. I think the alternative to that is if interest rates don't give, but something has to, and home pricing, starts to reduce, rents start to reduce in a meaningful way. That's the other way to achieve it, but that doesn't happen very quickly. I think one of the challenges that they have is trying to read all of the economic data and see this, this U.S. economy that kind of moves, like a big battleship very slowly, but once it starts to turn, it can overcorrect as well. And so trying to get, the timing of rate cuts, to where they're happening when it's needed, but not overstimulatory to drive inflation back up, but not too little too late, which is kind of what they did on the way up, driving up interest rates in the first place in response to a lot of the stimulus. But it's just, there's a lot that goes into it. I mean, I wish I better understood, exactly what the right call was at the right time. Not that it really matters because I'm not making the call anyway, I guess. But there's a lot that goes into trying to dial this in as to what should be done and when. And Yoon made an interesting, comment, I think, about what one way could be to help drive down the inflation. I mean, we've gone from 9% to 2.4%, and they're worried about the last half a percentage point, to get to their target of 2%. It's definitely headed the right direction, but does it overcorrect? And then do they have to start stimulating? I mean, that's one of the alternatives.
And I know the administration wants this drop in the Fed funds rate, and I saw someone opining, and I think it's probably true, that you would have had rate drops already if Liberation Day and this tariff plan had not been set in motion here. So we are where we are right now, and I think there are, I mean, you start to see some of these Fed chairs talk about, or governors talk about interest rate cuts, 2 or 3 of them in the back half of this year. And I think that's what everybody is waiting for, is when do we get that? Tariff clarity is probably going to help there. July 9th on that subject, Jeff, is an interesting date. This is the 90-day moratorium or pause on the enormous reciprocal tariffs that the administration put into place would expire. I think a lot of folks, I think there are 3 options on the table: that the moratorium will extend and the pause will extend to allow more time for negotiation. We know that deadlines generally make deals happen. And so maybe this is a case where deals can happen. I saw that Trump had planned to send out letters to all the 130 countries with a take it or leave it sort of offer. And I've seen Lutnick, yet again saying you're going to start seeing deals announced next week in a lot of them. We saw that a China deal was noted as being at the finish line, subject to approval from Xi and Trump. So, I don't know. We're still in a state of flux. I think nobody believes anything that's being said as it relates to tariffs right now, because it does seem like a lot of missed promises.
Well, I think that's exactly right. And you've often said, you'd rather talk about what's actually been done as opposed to what's going to be done or coming down the line, right? And that resonates here, because you just start to lose credibility in the public when it's like, this is coming, and it's still not here. I do think there's something to the, deadlines driving deals or forcing some action that might otherwise just take longer to come to pass. So, hopefully that some of those actually get over the finish line. You start to get some momentum. I think if countries start to see more deals coming forward, that may put some pressure to jump on as opposed to be left behind. Right now, UK is the only one out there, is not the momentum that I'm sure they're hoping for at this point.
You bet. Well, Jeff, I am the segue guy on this episode. And we'll try and take us into artificial intelligence discussion. I think a lot of what we're talking about here is some tools and things that we can be using out there, automations that can be put in place and that sort of thing. But a lot of it is still trying to understand just what we have here by way of these large language models, this amazing discovery that's here that really seems to be changing a lot of folks. And trying to digest the playing field, try and digest the messages from the players on the playing field. I think we were talking about a realization and a necessity to identify who you're listening to's allegiances lie. Are they aligned to artificial general intelligence that fixes everything? Are they aligned to none of it mattering a whole ton because they don't have plays into that? And that leads us to a really interesting paper by Apple leading into their developers conference. They had released a study that they had put together that was saying, look, let's not get too carried away with these large language models. They are effectively really good memorizers and reciters of things that they have memorized. And so the language model can memorize an enormous amount of data and recite that back. But when the parameters of the question being asked grow to a certain point, that they just fall flat on their face, really every which way according to this test. Now, Apple's got no play here, either awful management or a assured decision. I don't know, but they have no play here right now. And so it would make sense that they would be trying to argue that they have not missed the boat. So it makes some sense there, but it does. I thought it was noteworthy to talk about because it strikes a chord of rationality in my mind. And in that's what these things are doing. And when you try and understand they're next word guessers. And, is that what thinking is? Is that what reasoning is? Even the word reasoning used to describe some of the features in a product or kind of the apps, leads you to think it's reasoning here, but is that really what it's doing? So an interesting counterpoint.
Yeah, it really was. And it's, It's hard to know how cynical to be or not to be in some of these scenarios, right? Because as you laid out, Mark, I mean, they don't have a leading edge, large language model or AI system that they're out trying to sell to everybody. And so on the one hand, yeah, they've got motivation to maybe downplay what this is and what it isn't. But as I looked into that article, kind of read through a little bit of their white paper and stuff, a lot of it does make sense too, in the understanding how the artificial intelligence and specifically the large language models, what are they doing and how are they doing it? And is that really the same thing as human like reasoning and thought and consciousness? No, I don't think it is. There was a really interesting takeaway. Maybe I'll just read this. That says LLMs are not reasoning; they're more like human-wide cross-programming language, global hash consing or sorts. You have to explain to me what that means, Mark, maybe offline. But it says this is extremely powerful and will advance in many areas, but is not going to result in AGI. So in part making the case LLMs aren't going to turn into AGI from their perspective. It goes on to say, that said, what most miss is the real lesson taught by LLMs. Mass compute added to otherwise simple algorithm yields immense power and utility, which does make sense. I mean, they're throwing a ton of compute. They talk about the clusters and how much like compute power, how much investment in the hardware, how much electricity they have to take to run through these things. They really can do, powerful things and have meaningful utility. But they're probably not going to morph into, in their current state or the way that the LLMs are constructed into a general intelligence, that is, it seems like it's general intelligence in some ways, but I don't think it really is. And that's the case that they're making here.
Yeah, boy, Jeff, I think that last sentence kind of bears repeating and a description of what LLMs are and what the epiphany really is mass compute added to an otherwise simple algorithm wields immense power and utility. And I really do think that hits home to me. And it is not to downplay the effect. My goodness, it is just enormously impactful. But I do think that it probably speaks to the likelihood as things sit today, and they're advancing quickly. But as things sit today, the replacement of a lot of people will require some level of AGI beyond the low-hanging fruit. And I think, without the magic of reasoning or whatever would come next, I think we're a little further a ways off. That's what the message I take from it. And it certainly matches a little bit with what I'm saying or what I'm seeing out there. And as I'm assessing it all, then we ought to put a list of all these comments that we've talked about here and who the person talking's allegiances are to, and then is it pro, the end of the world as we know it, or not? And it's pretty clear who's motivated by what. But Ilias Sutsgiver, I'm sure I'm messing that name up, but a really well-known AI guy is saying, look, it's going to do everything within 10 years. It's going to do everything that humans do, and comparing that what the brain really does is overly kind of simplified. This is what language models are doing. And so, he is certainly one that is in the camp of benefiting from and building this sort of AGI solution. And so, another person in comments this week that it's going in that direction. So just a lot to process. I think constantly pulling in these data points here and assessing is a prudent thing to do.
It is, it really is. One thing to me is clear. We're definitely living through kind of a revolution, or at least a next significant wave of technology and innovation, and for whatever it's worth, Mark, trying to see or seeing how much investment and how difficult it is to try to replicate kind of the magic and frankly, from my perspective, divinity of like what human and what the human is, that we can do without trillions of dollars of investment and infrastructure and power, thrown at us. Just the ability to organically, compute, have reasoning, function, self-repair. Like there's just a lot of stuff that it's fascinating on the one hand to see what artificial intelligence is doing, how it's evolving, but it also just, is still a very stark contrast to what you and I were born doing, and maybe our intelligence doesn't match up to many others that are out there. But it's just fascinating to see how big of a gap there still is, even given even respecting and appreciating how much change, how much advancement there is on the artificial intelligence front. It's still a really long ways from the human intelligence that we experience and deal with every day.
Well said. Well said. Well, we'll keep kind of watching this and throwing some stuff against the wall here and see what sticks. And we might as well close out maybe a little bit shorter podcast for market moves this week, talking about something a little bit more positive. Jeff, the consumer is looking up a little bit. The confidence is improving here. What do you see there?
Well, the consumer's not worried about AI taking over the world just yet. So the conference board, we've referenced this in the past, but the conference board, puts together their consumer confidence index. And the headline kind of grabbed my attention, Mark, because there had been 4 months of consecutive declines in consumer confidence for the last 4 months, but it kind of had a sharp rebound and it was up 12 basis points, from the prior month's reading. Some of that I think sparked optimism by some of the deals that had been announced. Now this had come out later last month, later in May 2025, and so they'd started to get some announcements around tariff either relief or deals or I think some of the concerns of it falling off a cliff were cited as one of the reasons for a little bit of the rebound in the confidence. Is this a blip or is it a trend? It'll be interesting to continue to follow, but it seems that on average, the consumer is maybe not feeling quite as negative as they have been for the last 4 months, leading up to May through, the beginning of this year. So I don't know where it goes, but it was, interesting, and we'll welcome any signs of optimism that are, that are to be had.
My guess, Jeff, if another read was taken today, that it would be quite a bit more negative than whatever was there at the end of May. Don't know that to be the case, but that would be my guess. So hopefully we have great news and full of optimism to close out the second half of June, and that reading is continued on the upward trend, and all sorts of good things that will come from that, including a more active real estate market.
We would welcome that if that's what in fact we get. We'll keep monitoring that and see. But yeah, it's some interest rate relief would be helpful. I think that would drive a lot of consumer optimism. A lot of people sitting on the sidelines hoping for something to be optimistic about. So we will try to will it into existence for everybody out there and keep carrying on in the meantime.
Very good, Jeff. Well, enjoyed it as usual. Look forward to next time. Have a great Father's Day to you and to all those out there.
Appreciate it, Mark. Same to you. And we'll be back to report on it next week.
Very good.